Hello and welcome to today's daily educational video here at Forex.Academy. My name is Robert Blackwell, as always, and I have the pleasure to walk you through today's education. Now, before we do so, please consult the following disclaimer. There is risk involved trading the financial markets. And the content of today's particular webinar, we're going to be looking at the specific technical indicator known as Bollinger Bands. There are many ways to trade the Bollinger Bands here as a technical indicator. It is based off standard deviation from the mean, which we'll look at and develop on how to trade using the indicator. So first and foremost, we can ask the question, guys, why use technical indicators? I'd like to lead with this then. Leading indicators work especially well during periods of sideways market movement. This is due to the fact that many leading indicators are oscillators. In a sideways market, however, lagging indicators are almost useless. Since the market has no clear direction, they can provide random indications. So that's not good for our trading, obviously, and often provides us with absolutely no signal whatsoever. None of these indications, however, can make for valid predictions about future market movements, okay? And it's very important to understand, guys. We have two separate types of indicators that we know as leading and lagging indicators. Some lead price or some lag on price. And obviously, if you're trying to follow the momentum in the markets, you're trying to depict a scenario where momentum is trying to move or predict the movement of momentum before price as a leading indicator. So let's look at Bollinger Bands specifically themselves. They are placed over a price chart and consist of moving averages together with upper and lower bands. They are based on statistical standard deviation from the mean. Okay, so what does that mean? Well, we'll have one moving average going through the price, and then we can choose our own deviation from that average price to give us an upper and a lower band. The area between the moving average line in each band produces a range or channel. Bollinger Bands show relative volatility changes through the width of the band themselves. The wider the bands, the greater the volatility, and obviously the thinner the bands, the less volatility there is in the market. So how can we look to actually trade this type of indicator? Well, what we have here is a price chart. This is the cable market or the pound sterling forex market here. As you can see, guys, price is moving from left to right. The bands are widening and contracting with volatility after the fact, okay? So they are therefore a lagging indicator. The price moves, and as that price moves, the bands are going to contract or widen to reflect that movement in price. However, they do outline a certain level of structure to that price with the volatility. Perhaps for some of us, if we like to trade market conditions where the volatility is slightly lower, then we can look for periods when these bands are actually contracting. And that means that we can dictate the term of the trade. Perhaps if we're looking to simply trade short-term trades, of course, we don't want to experience too much volatility. Perhaps we want to be in the trade for only one particular day. It might not necessarily be a trend trade, just a short trade in the market, perhaps a daily scalp or intraday swing that we're looking to trade off. So we'll look for those times when these bands are contracting and therefore obviously are experiencing less volatility. That's one way we can use these bands. Of course, to the right hand side, we can see the market actually trading up and touching one of our standard deviations here. So this set of Bollinger Bands we have in front effectively are using a standard deviation of 2 from the mean. So as we go to our price chart here, we can see, well, this middle line is our moving average line. Okay, it's moving up through the average price. And then we've selected 2 standard deviations from the mean. So this upper band here is 2 set standard deviations from a 14-day period, and then 2 from here. Now, as we get the market trading up right at this price level here, we can decide to do 2 things. If we think that is a breakout in terms of the market pushing up, we can look to capture that, because ideologically we can say, well, there's something significant perhaps going on in this market, because the market has traded up and has touched and closed above 2 standard deviations from the mean. It could give us one signal to possibly say we have a possible breakout opportunity from this new price pattern. Alternatively, that's why we should take the volatility into effect. If this is considered not a very volatile market, we may actually look to sell this price, because it gives us the signal that perhaps the market is trading to the downside here, and we simply get the market popping up to touch our standard deviation line. If it reverses from this line, we can look to sell that. And again, it might not be a full trend reversal. All we're looking for perhaps is it to come back to the mean price of the overall trend structure. So there's several ways to actually trade this indicator and use it to supplement, of course, with other indicators. Let's look practically on our price chart to see how we may look to install this indicator. Here we have in front our JFX trading platform, and we have the Australian dollar against the Swiss franc here. We'll go to insert and let's go to indicators here. Of course, we'll look at the trend indicator and we'll select Bollinger Bands. Okay, so what you're going to see here is the two choices. The period, of course, in terms of the daily periods in this price chart, we can choose 14 days. So we'll choose an average in price over the last 14 day periods. And then the standard deviation, of course, we'll set it to, and we'll just keep it at blue there, okay? That's going to effectively place our Bollinger Bands across this market. So when we zoom out, you can see how it consults to the trend line. Now, obviously, this indicator can break down in terms of giving a signal when there's a very strong move in the market. Alternatively, you could look to breakout to trade that breakout if that is occurring and if you think it is significant in terms of a breakout from the mean. Whereas when we get more collective pricing in terms of perhaps a level of price consolidation, which I'll just highlight on screen here to the right, this is a level of price consolidation that we can look to trade. Now, of course, if you're looking to just simply say, well, where is the level of support or resistance in this market? How can I effectively get those trades off? What you could do is use a complex confluence of indicators. So you could place your level of support there and there to say the market is consolidating between this period, and we might look for some price action. While we zoom in, we could then add a little more technical influence with the Bollinger Bands themselves and say, well, if we believe there's not going to be a breakout of price, we're looking to trade this sort of movement here. When do we enter the market? And the answer is, well, using this technical confluence, the best trading opportunities will arise. So, of course, we have one here. That is our first level. It might be difficult to trade because it's the start of our price consolidation. Then when the market reverses, we have these levels here. So we have our two defined levels as well. I would say, of course, the best time to look to trade this, given the technical confluence between the two indicators, is this here signal here. So effectively we get the candlestick here, we get the candlestick trading up and reversing off our Bollinger Band, our top Bollinger Band, and then there's a bit of a trade to the downside again. If we look for another signal here, see this Bollinger Band here, it just comes down and touches the standard deviation from the mean again through that price and reverses up through that. So if you're trading that intraday, that could be a signal to say, well, I don't think this market has any significance in terms of its movement. I'm looking to place an intraday trade just to bring this market back up to anywhere in towards the mean. And again, that can be a selective trade where there's less volatility in the markets. Of course, if you see a much more extensive move, perhaps a break over total level of support, this level of a close below, and of course we have a significant break of the Bollinger Bands from the mean, we can say this market statistically with these two levels of indication is going lower. So we're supplementary using technical confluence there with our acknowledgement of the volatility in the markets, given it's also signifying the volatility there between such a range, to look to compound on some technical analysis there. So that brings us to the end of this daily educational video discussing Bollinger Bands. I hope you enjoyed it and are able to use it more often in your trading as a piece of technical indication for confluence. Thank you for joining us here at Forex Academy. We'll see you next time. Bye for now.